Brian, let's talk about the size of the various markets: stocks, bonds, real estate, insurance. What is the largest sector?
Yeah, the largest sector actually is bonds. And so that's why I wanted to talk about this, because a lot of people talk about the market, the market, the market. Well, I always ask, which market are you talking about? Are you talking about the part that's stock market equities globally? Well, that only accounts for about 17% of the assets that you can invest in passively. So that's not the market. And even the equities can be broken into much smaller segments, U.S. versus foreign, large cap versus small cap, et cetera. And so when we look at markets, I want to kind of define that.
Okay.
The biggest area is bonds. So I mean, bonds are well over $100 trillion. These are just loans to corporations and to governments and municipalities. That's what a bond is. So that's the biggest category out there. So if you say, gee, how'd the market do today? Well, if you really look in the math, you'd be quoting the bond market. How'd the bond market do today? Because that's where most of the money is out there. The next biggest category is the stock market. Behind them is real estate, not too far behind. So real estate is almost, the value of all investment real estate is almost the value of all publicly traded stocks out there. And the next category is the insurance company products, whether that be annuities, permanent life insurance, and then finally cash and cash equivalents is the remaining category.
So how large is the gap between bonds and stocks? Is it really large?
It's really large. There's probably at least 3 times as many bonds out there as there is stocks as far as value. Now, that's an interesting thing to look at, because if you just say, well, maybe I'll just have a representative mix of the markets. Well, if you did that, you would have more than half of your money in bonds. And you may say, well, wait a second, bonds don't really pay very much. That's right, unless you have junk bonds, and even they don't pay that great anymore. Well, don't bonds lose money when interest rates are increasing? Yes, they do. Well, then why would I want most of my money in something when I think interest rates are going up and it doesn't pay me that well to begin with? Wouldn't I lose money if rates go up? You might. And so we're looking at the biggest asset class out there that's bigger than all the other ones put together. And so a lot of people have money in it, but when you kind of look at that asset class, a lot of people say, why am I in it? And so that's why we want to have this discussion, that there are certain places you can put your money. Again, bonds, equities, passive real estate, insurance company products, cash and cash equivalents. There's not a lot of other places to put it. So we need to look at these, look at the relative size of them, and say, well, maybe I should have some of these different categories in my portfolio.
So, Brian, considering what you said about bonds and the negative aspects of those, why do they make up such a large percentage of the market, do you think?
Well, historically, bonds have been low volatility-wise. They don't move up and down. And frankly, for the last 40 years, as rates were falling, bond values increased. So when rates are falling, they're a great thing to own. And it used to be you get really high yields, too. So you'd buy a bond. It's not very volatile. It pays a really nice yield. You're making money on the underlying bonds as rates decrease for new bonds. And so you're living large. That was a great investment for a long time. I'm just saying you might want to look at it now, because I don't think that rates are going to drop for the next 40 years. And of course they're not. They can't. And so the yields are really low compared to what they used to be. It used to be, they'd pay 5, 6, 7 high quality bonds percent, and now treasuries are much, much lower. And so when you look at the bond market now as compared to what it used to be, it's just not as attractive as it used to be. And that's why a lot of money went there, primarily again out of concerns for volatility.
What would have to happen in the market or the economy to make bonds lose their, status?
Well, I think there's always going to be demand for bonds for safety, again, lack of volatility, liquidity, and so forth. There's reasons to buy every asset class out there. There's strategy detriments to every investment class. There's benefits to every investment class. So where it comes to bonds, just have to look at that and just consider, the point of this talk was just to consider where are your assets relative to the big categories and relative to the size of the overall markets.
Brian, thanks for telling us more about the size of the markets.